Like we just saw in the previous report, the U.S. Federal Reserve has reduced its benchmark rate by 0.5 percentage point, aiming to support the job market amid slowing growth. For more on this, we're joined by Professor Hwagyun Kim this morning. Dr. Kim, thank you so much for joining us.
Pleasure to meet you.
So, like we just saw, the Fed made an unusually aggressive move. What's your take on this?
So the 50 basis point cut is somewhat expected. According to the Fed announcement, the Fed watch projections based on the futures data indicated that about 61% probability of a 50 basis points cut and about 39% probability of a 25 basis point cuts. So the market was expecting a larger cut to some extent, although there was a big divergence. This expectation also reflected in the dot plot in that we had like several people, officials talking about 25, others are talking about 50 basis points. So clearly there was some divergence, but clearly market was expecting some. What is more aggressive, I think, is about the future projections. According to the dot plot, about 7 officials forecast 1 more cut, 9 see 2 additional cuts, and 1 predict 3 cuts by the end of the year. So on average, it's about 2 cuts additionally, I think, by the end of this year, but at least it's going to have a continual cut. So most officials expect the Fed funds target will hit about 3.4% in 2025 and about 2.9 to 3% by 2026. So this is a gradual movement, but still very significant move. And this tells us that the Fed is not only easing the economy with a larger cut, but also providing a long-term projection for lowering the interest rate cuts. I think that's the being aggressive part.
Right. Like you just mentioned, the Fed signaled that they plan to cut rates more by the end of this year. Could you explain more in detail what might be the reason behind this decision?
Well, the significant rate cut and the long-term lowering plan suggest that maybe the Fed believes the inflation is still not fully under control, but it's now more crucial to achieve a soft landing for the economy. So through these kind of cuts, the Fed aims to assure that the market, that the liquidity provision is not an issue. This means that firms and households, especially looking to borrow money for consumption and investment, will not be really hampered by high interest rates. And these effects of these cuts will not be immediate, but will likely become more apparent over the next few quarters. And as inflation approaches the 2% target, I think the real side of the economy is going to benefit from this lower rates, particularly in the first and second quarters of 2025. And I think what the chairman, Jerome Powell, is suggesting is also about this, that maybe economy can be slowed down. We're not going to allow this to happen just because of the high interest rates.
Right. And what happens now? How will rate cuts work their way through the economy, and how will they affect businesses and individuals?
Well, it's always somewhat convoluted, but like I just briefly mentioned, once the interest rate starts going down, then clearly this is going to affect the banks, the lending rates, and also borrowing rates, et cetera, and also some other, the parts of businesses who need to use debt financing for their investment and then economic activities, for instance, like paying wages, et cetera. So as the interest rate starts going down, then the long-term debt financing would be affected, for instance, because we already see that the Fed is going to lower the interest rate for the long period. Then I think long-term rate as well as short-term rates will go down, and that actually can just help debt financing with lower cost. So the investment probably will increase at the end of the day. And also the individuals who want to buy homes and cars and these durable goods eventually will be affected. So I think that's going to have some positive impact. What is not so sure is in between. And therefore, this is going to have some uncertainty about how to digest information, especially by the financial markets, such as stock markets.
Right, like you just mentioned, how will the change in interest rates affect the stock market?
Yeah, so I think the stock market, basically price is always talking about the future cash flows and discount rates, right? So because interest rates are going down, not just for just, the short term, but also the long term, this is going to lower the discount rate. And then that actually will increase the price. And also, cash flows will be more positively affected, at the end of the day, because, it's easier to borrow and then you can actually, get into more economic activities. However, as we just mentioned earlier, this type of the aggressive cuts and also the long-term plan for reducing the rates kind of, make investors and market participants actually start suspecting, well, maybe they're aggressively lowering this because they're expecting the slowdown economy or even recession. If that's the case, maybe the discount rate actually can go up and cash flow expectations can go down because of worry about the, this recession or the slowing down economy. Therefore, there could be some short-term fallback or pullback of the stock price. For instance, today, the S&P 500 slightly went down because they just digested information by 29 basis points.
Right, and how will lower U.S. rates affect the South Korean economy? Do you think it'll affect the Bank of Korea's decision on interest rates schedule for next month?
Yes, I think now the Bank of Korea is considering a lot about what to do the next. Because on one hand, if the interest rate is not going to move much by the Bank of Korea, then because of the lower gap between the U.S. and the Korean interest rate, exchange rate is going to be actually in favor to some extent. So I think the exchange rate is going to just get better. And that's going to have some positive impacts actually for the import prices of oils and raw materials. And also, I think when you compute the GDP and things like that, if exchange rate is not deteriorating too much, that's going to be helpful. So there will be some positive impacts definitely. But if you just actually do not lower the interest rate, the consumer sectors and the firm sectors will have some issues. So the Bank of Korea wants to probably lower the interest rate at some point, but they probably don't want to do it right now because of really big household debt burdens, as we know. And if the interest rate goes down, then housing market is going to have also this higher, than positive impacts. And the lower interest rate means the increase in further of the household debt. And that's not something that the Bank of Korea or the government really wants. So there will be some balancing effect. And I believe that there will be some sort of delayed kind of responses. And I think that's what I guess.
Right, I guess we'll have to see how it goes. All right, Dr. Kim, thank you so much for your insights this morning. We appreciate it.
My pleasure, always.